All right, everyone. Good evening. Today is Thursday, October 22nd, and let's talk about the financial market news of the day. All right, so we saw a slight uptick in equity markets across the board. However, we did see particular strength in financials. We saw banks leading US stocks higher, with financials up 2%, and energies producers also surging, rebounding with oil from the prior day's sell off. Small caps rose about 1.5%, and tech shares did underperform on the day, as indicated by NASDAQ performance, but AT&T was a single name that did rally after the phone giant added more wireless subscribers than analysts had estimated. US stocks did rise specifically because of more confidence on a possible stimulus plan, with Nancy Pelosi coming out to say that she is just about there on stimulus plans with Mnuchin. Senate Republicans, however, do remain the ultimate roadblock to a plan. Obviously, this is a huge deal. Top line's about 1.9 to 2 trillion US dollars. And the top Republicans in the Senate still have not seen anything. So this is a big question that remains. Brown Book data today did also show a drop in jobless claims, suggesting that the labor market was performing strongly and recovering quickly. Gold declined about 1.4% to 1,092, and copper slipped after topping $7,000 a ton for the first time in over 2 years. WTI increased 1.4% to $40.60 a barrel. Yields climbed with the 10-year going all the way up to 84 basis points. And remember, just a couple weeks ago, we had the 10-year trading in the mid 60s between 65 and 68 basis points. So this is a pretty big jump in the highest prices since, or the highest yields, lowest prices since June. The 2-year rates were up about 1 basis point to 15 basis points, and the Bloomberg Dollar Spot Index gained about 20 basis points, showing a slight strengthening in the US dollar. All right, so let's talk about some international stories and then we'll bring it back domestically. Talking about HK Connect, this is the Hong Kong Connect program. The Chinese ETF market has been opened globally through 4 feeder ETFs. So right now, there are ETFs that do give exposure to Chinese equities. However, they are based in Hong Kong, London, and New York, and their divergence from NAV, net asset value, is incredibly substantial, about a whopping 15% at the widest. And so with this in mind, China's fast-growing $157 billion market for ETF funds will be able to be accessed through these 4 ETFs, 2 of which will be based onshore in Shenzhen, and 2 of the others will be based in Hong Kong. In Shenzhen, you'll have coverage of the Hang Seng China Enterprises Index and the S&P New China Sectors Index. Hong Kong will allow access to the benchmark CSI 300 index, and also some gauge of China's 5G companies. They will collect capital locally and settle trades across the border for the equivalent of about 900 million yuan, which is about 135 million US dollars, that have already been gathered in the pre-sale of the S&P New China Sectors ETF alone. Obviously, we see investor demand there. Let's see if it continues. ETFs in China have nearly doubled in value over the first half of this year, seeing the uptick coming out of the recovery from the coronavirus crisis. So it'll be great to see if that continues. OPEC Plus has a possible output hike, and Putin says that Russia is open to delaying planned OPEC output hikes. So Putin wanted to adhere to the current plan before. However, this is the latest show of unity between Russia and Saudi Arabia, whose leaders have been oftentimes engaged in very intense telephone diplomacy over this past month. The Saudi Arabian Crown Prince has called on the cartel to be proactive and ready to head off, quote unquote, negative trends and development to nip them in the bud. Not directly mentioning OPEC, however, alluding to OPEC through the usage of the term cartel. Russia's overall compliance with the OPEC deal has been running between 96 and 97%, which is extremely high, coming off the comments made in March where they said they might pull out completely and their cooperation with OPEC could be over, given the Saudi Arabia-Russia price wars. However, the situation seems to have stabilized and their relations have strengthened. The pound surges the most in 6 months today on market confidence over the issue of Brexit. The sterling has risen as much as 2% to 131 against the dollar. And rather than walking away at the deadline, apparently now there's some sense that we have some broad idea of a possible timeline for a potential deal rather than so we do see dollar weakness across the board. Again, slight dollar strengthening today, about 20 basis points against that broad basket for the Bloomberg Dollar Index. However, we've seen this short to medium term trend of dollar weakness, and this did contribute to the move. Options traders did not join the bullish sentiment shown in the spot markets for the British pound, with demand for the pound steady in risk reversal bets, which is an options parity trade where you're long and short calls and puts respectively. This did, not surprisingly, hurt the Haven UK bonds. They extended losses to send the benchmark 10-year yields up about 6 basis points. So obviously falling in price and rising in yields to about 25 basis points. And this is the highest in a little bit more than 1 week. Obviously, the yields in the UK on that 10-year are lower than in the US, but still pretty high in comparison to where they've been in this ultra low yield environment. The last international story we want to touch on is Oman warning on debt. A couple days ago, they tapped the international debt market with a $2 billion bond sale denominated in US dollars. Their public debt could soar to 130% of GDP in 2025, and the total government debt is estimated to be at about 78% of GDP this year, but is planned to rise to about 86% of GDP by 2021. Oman has been getting hit pretty hard from the coronavirus pandemic, given limited health resources in the country and also lower crude prices, like many of the other countries in the region. This has raised the possibility of assistance from its Gulf neighbors. However, it does continue to be rated junk by all three agencies and single B plus by the S&P. All right, let's talk about some more local stories. Let me grab a sip of water first. We've got 8 different things we're going to talk about here. Firstly, Mattel soars with sales up on high demand of both Barbie and Hot Wheels. Compared to a lot of its competitors, it is not, it doesn't have sales that are necessarily tied to releases of new movies. It's not like Disney where products are related to Disney movies. It is more independent. So as movie producers struggle during this time, companies like Mattel are succeeding. However, shares are still down 6% on the year, given weaker sales in the first half of the year, with top line down about 14%. However, we did see doll sales surging about 22% over the third quarter last year. Mattel shares were up about 12% in aftermarket yesterday, coming off of the news. They expect a stronger than normal holiday buying season. Again, like a lot of firms on the street, they have withdrawn their guidance already. Moderna has gotten 30,000 patients for the final stage of its vaccine trial, which means 25,000 volunteers are getting the second shot. We do have that control group as well. They could get an initial readout on whether the vaccine works by late November, which is a bit later than Pfizer's deadline, where they've been working with the German biotech BioNTech SE and do expect results from the 44,000 in-person trial by the end of this month. Moderna is up about 5% today and 300% on the year. U.S. mortgage rates also slid to a record low for the 11th time this year, as reported by Freddie Mac. The 30-year fell to 280 basis points, which is down 1 basis point week over week for the lowest in 50 years. So this is the 11th new low of the year. And this is the lowest in 50 years, which is the entire time series over which Freddie Mac has collected this data. Lower mortgage rates, also combined with scarce inventory, will drive up prices given that increased demand for home buying. However, given the Fed's intervention in the market through whatever you call this version of quantitative easing, we do see a backstop in the market that are keeping things flowing. Moving on, we want to talk about BC Partners. They are going to split PetSmart and Chewy through a recapitalization deal. They had tried to do this a couple years before and consider this recap to be less controversial than previous distributions due to the simultaneous refinancing of the entire capital structure and equity contribution from the sponsor. This basically means that they're going to recap PetSmart with 1.3 billion US dollars of equity and 4.65 billion of debt. Chewy is going to be fast growing, or is currently a fast growing but unprofitable online retailer, and will now become a wholly separate business. It'll have a smaller debt load relative to earnings and longer maturities for PetSmart. This will allow both companies to trim leverage and extend out their maturities, especially on the PetSmart side, seeing that they still do have that large figure of $4.65 billion of debt. Not surprisingly, this is going to be made up of both term loans, term loan A's, term loan B's, and junk rated bonds. All right, so Avangrid has also expanded in the US with a $4.3 billion deal. So, this is the deal to buy the power provider for $50.30 a share at a 10% premium, valuing PNM at 8.3 billion US dollars, including debt. This is the company's eighth acquisition since the start of the pandemic. They just bought Infigen Energy of Australia. This deal will give Avangrid a bigger presence in the US Southwest. Obviously, Avangrid is very prominent in the Northeast right now, so we will see that expansion. This deal was not well received by investors on the side of Avangrid, with shares plunging as much as 9.5% in New York trading today. However, on the other side of the table, PNM did rise about 10%, up 9.3% on the news. Not surprising, obviously, given that it is purchased at a 10% premium in an all-stock transaction. Viagogo and StubHub are in peril as the UK watchdog targets tech M&A. This is their version of American antitrust, with investigations by the British competition watchdog showing that the 4.05 billion US dollar purchase of the former eBay unit will actually hurt consumers and defer competition. The Competition and Markets Authority, the British CMA, had started an in-depth probe of the deal in June amid antitrust concerns. So they had reached a provisional decision Thursday today, showing that fees for consumers would increase and the quality of services could deteriorate drastically. Viagogo and StubHub have over 90% of the market share and obviously combined and compete closely with each other. Facebook has also taken the CMA to court, also on antitrust issues, and forced it to pause its integration with Jiffy Incorporated. All right, two more things to talk about. Firstly, Deutsche Bank is in talks to sell its tech unit to Tata Consultancy, which is one of Asia's biggest software exporters by market value. It is India's biggest conglomerate, and shares fell about 1% on the news in Mumbai as Deutsche Bank stock was little changed, still trading about that 7.96 euro figure out in Frankfurt. The idea is by selling its tech unit, Deutsche Bank's chief executive officer, Christian Sewing, will get closer to its jobs cut target. Obviously, last July, he did come out and say that he was going to cut 18,000 jobs, a little bit more than half of which were supposed to be in Germany. Internally, this project is known as Project Utility, and Deutsche Bank is currently merging Postbank's IT with its own, which is expected to render these services not too useful. In addition, we have Canyon Bicycles, and Carlisle and KKR have both displayed interest in this. Canyon is attracting buyout firms Advent International, Apex Partners, and General Atlantic. But bikes have been increasingly popular this year amid the muscling, amid the different, I guess, aversions to taking public transport. So they have become a more preferred type of transportation. The US-based private equity firm TSG Consumer Partners had also bought a significant majority stake in Canyon in 2016, so it will stay involved in the transaction to some degree. All right, everyone. Well, thank you so much for tuning in. Look forward to seeing you on Monday for the next episode of Market Newsflow, and have a great weekend. Thank you.